Good morning. Thank you for joining and welcome to the second in our series of tax year end behind the scenes webinars with Blackfinch. I'm Tim Wynn-Jones and I'm joined again today by Dr. Nick Pillow from the Blackfinch Ventures team. Many of you on the webinar today attended last week's webinar where we discussed our new portfolio edition GT Wings with its proprietary air wing technology decarbonising commercial shipping. But we also have some new attendees joining us for the first time today, so a very warm welcome to all. Through this series of webinars, we're aiming to give insights into new investments and prospective areas of investment in our ventures portfolios. We're particularly focusing on our energy transition EIS portfolio, as this was a new product launched in October last year. So it gives us a great opportunity to highlight how we identify prospective investments, how we assess them, and how we convince the ones that we identify as the most promising to take investment from Blackfinch over other investment providers. The webinar is scheduled for 30 minutes. It is being recorded, so it can be accessed and shared afterwards. And we again plan to leave time for questions at the end. So please use the Q&A function to post any questions you may have. And if we don't have time to answer them today, we will be sure to come back to you. As a reminder, Blackfinch is regulated by the FCA. So please be aware the contents of today's webinar do not constitute financial advice. And also on the next slide, another reminder, EIS investments are classified as high risk. So you shouldn't invest unless you're willing to lose all of the money that you do invest. Albeit with EIS, there are tax reliefs and loss reliefs that provide investment protection. So please speak to your regional business development manager or contact us if you'd like to understand those in greater detail. So moving on, as we discussed last week, we developed the Blackfinch Energy Transition EIS portfolios for a number of reasons. Firstly, in response to the climate, regulatory and market conditions that are compelling multiple sectors of the economy to transition away from fossil fuels to green energy and clean tech. Secondly, because our advisor and investor base gave us direct feedback that this was an area of interest and excitement. And thirdly, because we were and are continuously seeing exciting technology companies emerging and growing in this space. So as you can see from the investment framework, we invest in companies developing technologies across the three largest greenhouse gas emitting sectors of buildings, transport and industry, and across three technology themes, which are generation and storage, distribution and digital. Now, what we're doing through this series of webinars is really trying to bring this to life. So moving on to the next slide, you can see here, last week we covered GT Wings, and the eagle-eyed amongst you will also notice a new logo in the top right. So at the start of this week, we were delighted to publicly disclose our investment alongside some global names, including Shell Ventures and Toyota Ventures, into a company called Supercritical. Supercritical will be the focus of next week's session, but in a nutshell, it's a very exciting London-based company developing a state-of-the-art electrolyzer to produce green hydrogen from renewable energy. That green hydrogen is then used in industrial processes, such as the production of ammonia and methanol. So it's a really exciting company in a very, very key industrialization and decarbonisation space. And as I say, we will be focusing more on that next week, but very excited to see that one launched. And again, if you go to the Blackfinch website, you'll see some of the press coverage of that as well. But today we're going to focus on Adia Thermal. So this was our second energy transition investment. We made that investment at the start of this year. And for that, I'm going to hand over to Nick, who first has another quick update on GT Wings. Nick.
Thanks, Tim. And yes, starting with a quick update on GT Wings, because I mentioned last week that we were very excited that it had its first wing installed on a ship. And it's the Vectis Progress, which you can see in the picture there. So we've now got a real picture of their very first wing, that thing on the front of the ship there, which helps push it along and should be reducing its fuel consumption by about 10%. And it first of all went down to Bilbao in Spain. And you can see it's now set off across the Atlantic and it's heading for Canada. It's almost worth the $20 a month to get the live satellite tracking, but a slightly out of date position there. You can see it heading out, and I think it's due to arrive shortly before next week's webinar. So maybe we'll check in on its progress next week as well. Anyway, the focus for today's session is actually on Adia, which, as Tim said, is a buildings decarbonisation technology company. And it specifically works with heat pump technology. Now, heat pumps are very well established. We would not be investing in another heat pump manufacturer. But Adia's got a much more interesting niche. It's providing technology that makes it very quick and easy to connect a heat pump to an established, typical heating system that you'd find in UK homes that has in the past been run by a gas boiler, so that you can rip out your gas boiler, replace it with a heat pump, and where that, typically in the past that's taken maybe a couple of weeks from a specialist installer, very often having to make quite significant changes to the existing heating system. With the Adia technology, an existing boiler installer can put it in 2 days for the same cost as putting in a replacement gas boiler. So all those people who think, oh, I've heard of heat pumps, maybe I should be doing that. The government's encouraging that. Let's see. And they find actually they're trying to change their boiler because it's broken and it's cold. And they find out it's going to be 2-3 weeks before they've got this heat pump system up and running, and it's going to cost all that work from a specialist installer. In the meantime, they think, okay, let's just have another gas boiler. With Adia, it's a much more simple choice. It's like, well, same cost, same sort of time. All right, let's go with a heat pump. And so we can see huge demand, particularly in the UK and other countries with similar housing. For this type of technology, say making it really quick and easy just to join heat pumps to your existing heat pump system. I'm going to explain a little bit how this works. Probably not what you expected to learn about this morning, but just say a heat pump is when you're heating your house with a heat pump, it's just like an inside-out fridge. It's very well established technology. With a fridge, you do have a heat pump in there. It's taking heat from a cold place inside the fridge to a hotter place outside the fridge. And all that's happening with a heat pump when it's heating your home is it's taking heat from a cold place, which is outside, and concentrating it into a hotter place, which is inside. And so it's a very, very, very simple. But the bigger the temperature difference it's got to move that heat, the less efficient it is. And you can't run a heat pump producing water at the temperature of a traditional boiler, which is what then would normally feed into your radiators and everything in a house that perhaps doesn't have the highest levels of insulation. You want to run a gentle heat much more continuously. And I was very lucky. I had the opportunity to build my own house. It was almost 20 years ago now. And my wife and I, said, right, well, let's put a heat pump in, because it's easy when you're starting from scratch. And we could say, right, we want high levels of insulation, underfloor heating, gentle heat that comes all the time. It's perfect for a heat pump. The heat pump's still running strongly, I should say. Should add. But when you've got an existing house which is full of radiators not so well insulated, it's a nightmare trying to do that, because what you'd normally have is very high temperature water running through radiators, and perhaps you've got a thermostatic valve and it will turn on or off, but that doesn't help you run a low heat continuously. And what you need to be able to do, and what Adia has the technology to do, is actually control the flow rate at each radiator. And it's got some very sophisticated processing. It's actually very difficult modeling that has to happen behind the scenes in that box you can see there, that works out the flow rate that it needs at any particular time. So if the sun comes out and suddenly this room's heated up and another one hasn't, it can adjust the flow, but it's all happening very gradually and slowly, and the heat pump can run efficiently and continuously, and so it works. You can't do that without this. It's very clever. The other thing they do that's really important is they work with installers. And it's not a case of having to work with the specialist installers. It's because I should maybe have put up in a photo of my my heat pump and all the sort of spaghetti of pipe work around it. It's really complicated to do these things. And that's why you need the specialist installers. But with Adia, they've covered all that. And so you've got a heat pump and you've got the box that you can see there, and it all joins up, and a normal boiler installer can do it. And that makes it again much easier to happen. And it means a lot more people are going to be offering heat pumps, which is good for the government because they want everybody to take heat pumps. But it's going to be very good for ADF because they can sell lots of their boxes. If we go onto the process, because I told you a little bit about our process last week, and about how when we started looking at the energy transition, we'd found, well, by the time we made the investments, over 1,000 companies, we'd seen the information from them. We'd whittled that down. We'd had over 20 pitches where we'd look in a lot of detail at companies, and we'd gone on to make those first investments. And so if I just run through that process quickly with Adia, we got the information. We got a pitch deck where they present their information. And as I said last week, we try to make sure we don't meet companies right at the start. We get one of our junior members of our team to meet the company and get some standard information. And so we got the information. We had a quick call, one of the junior members, and it was that junior member that presents that information to the team. And that's where we find, okay, heat pump company, probably not that interesting. Too many heat pumps out there. What's special? And it's like, it's not a heat pump company. It's got this special tech to join up the one to the other. I think, okay, that is more interesting. Let's look into it. And then we get the extra detail, and they're working with installers. So they're actually not having to compete against heat pump suppliers. They're not competing against installers. They're working with installers. The installers are the ones who are going to be selling this for them. They've already established relationships with installers. And the best bit was we discovered actually the installers that they've been working with had said, oh, this looks interesting, and had chosen to put this technology into their own homes. So even the installers who were already installing heat pumps hadn't put them in previously because it was so complicated and expensive to do. Suddenly they find the Adia technology and they think, this is my chance. And so the installers themselves were putting it into their own homes. And if that isn't a vote of confidence, I don't know what is. And so we said, right, this is definitely one of the interesting companies. And we went through to the pitch. And as I said last week, when we get to the pitch stage, the companies are very highly qualified at that point. We've already looked, we've discarded, well over 1,000 companies before we've got to that stage with this set of investments. And so we put a lot of resource in. We put multiple senior members of our team into a room with them for at least 3 hours, and we go through the fine details commercially and technically, trying to get to the bottom of what they have. And with Adia, it was clear it's a very early stage company. We like to have a good spread, some earlier stage, because we can get low valuations. We get a bigger percentage of the company. If it does well, then we get much bigger returns for clients. But obviously, there's a higher level of risk at that stage, compared to ones later on. So we want a good spread, but this was clearly at the very much the earlier end of that. Not everything they wanted to have, they have there yet, but that's fine, because what really, really impressed us was the team. And we always look very closely, particularly at the early stage companies in the team. We did a bit of benchmarking. We looked, okay, across all the companies we've come across, what sort of profile of founder is the best? And actually, there isn't one. There are lots of different personalities and types of person that work well as founder of a startup company. What's usually the best is to get a good mix within a team, and that's exactly what we found with Adia. Excellent, contributions from different people. So they had, within their very small team, the connections with installers. They had the understanding of the market. They also had the technical understanding. They had the understanding of how the heat pump side of it works in the installation side. But then very, very difficult sort of AI modeling that has to happen in order to be able to balance out dynamically these flow rates on lots of different radiators in a house at the same time. And it wasn't perfect. We could see that, and they were open about that. They were still working on it. But they had, certainly in our opinion, exactly the right people to overcome those issues and to develop it and to turn it into a much more sophisticated, slick, complete product over time. And so for the early stage companies, that's what we want. So we could see that they're actually addressing a problem that other people aren't addressing, working with installers, other people weren't doing that. And they have exactly the right team to be able to tackle that and to make a real success of it. And I won't talk through all the rest of the process, but in things like the due diligence, we spoke with some of the installers to make sure, yes, this what they're telling us is true, and it all backed up this picture that here is a very exciting early stage company, brilliant team tackling something that other people aren't tackling, and making some really strong progress in doing that. So that's Adia. Obviously, if you have any questions, do drop them into the Q&A and we'll pick them up at the end.
Thanks, Nick. So Nick alluded to it there, but heat pumps are a very exciting area. Some of you may have seen on BBC News, there was a feature last week where it outlined that a record number of heat pumps were installed in the UK in 2024 at about 70,000 installations. There is a government target for 600,000 per year by 2028. So it really is a technology that we're particularly excited about, and when we're seeing great traction in other parts of Europe as well, where the UK has some catching up to do. So it's a very interesting market supported by clear consumer demand starting to wake up to the technology, but also the regulatory support as well. So we've seen a number of the investments that we've now made, but as we highlighted last week, the ventures team is continuously building a pipeline of prospective investments, and that's so that we can deploy funds into high quality companies throughout the year. Last week, we talked about digital home energy management, and for anyone who missed that and would like to see it, you can see that on the Blackfinch YouTube channel. But today I'm going to explain another area of our interest, and this time it is last mile urban logistics. This fits within the energy transition investment framework within the transport and distribution space. So as we've all witnessed, there's been a dramatic shift in consumer retail and e-commerce over recent years. And that was particularly accelerated by COVID lockdowns. So many people will identify with this. So many of us now do the majority of our shopping online for home delivery. This has led to inner city congestion with delivery vans, and that's caused a lot of issues with traffic, parking, emissions. And as a result, there are swathes of regulation coming in across the globe, such as clean air zones and restricted access areas for cities. Now, a solution that's gained a lot of traction in cities like Sydney, Montreal in Canada, Paris, is electric micromobility. So think, for example, e-cargo bikes. These electric vehicles collect parcels from out-of-town fulfillment centres and transport them to homes in towns and cities, hence that last mile terminology that's used. Crucially, they can make those deliveries using cycle lanes. These are, remember, e-cargo bikes, so they can store parcels and all manner of deliveries on the back, and they can use cycle lanes and move past stationary traffic. So that means it's not just an environmentally friendly thing to do. It also saves significant amount of time and money for logistics operators. And these electric vehicles are significantly cheaper to buy and run than cargo vans. And it also creates associated infrastructure and retail opportunities with inner city mobility and charging hubs. So these can potentially also be used by the public, by ordinary people, to rent or charge electric vehicles like pool cars and community cars, e-bikes, e-scooters. So we're particularly excited about this area, and we believe it will continue to expand, and is ripe for new companies coming in and providing solutions in this space. So again, there's a flavor that you'll see through all of these areas of investment that we're exploring. There's strong regulatory reasons for solutions that are needed in the space, because either we need to reduce emissions, or we need to improve air quality, or there are various fines or targets that are beholden on these sectors. But also, it is where it makes economic sense for these changes to happen. So again, logistics providers aren't doing this just because of the targets. Yes, they've been driven to do it by targets, but it's also because they can save a significant amounts of money and improve their bottom line through adopting these technologies. So that's really important, and we're always looking at very tried and tested technologies. And as Nick highlighted, we really focus a lot on the teams that we invest in the companies and their connections into the market and how good they are at selling that into the market. We really want to see market traction, even if they're pre-revenue or pre-profitability. We just want to see that they have a clear line of sight and they really know their market. They understand the key players in the market. They have connections into those markets. Many of them may have come from larger companies in the space, and they really then know what it takes to scale the solutions in those spaces. So with that, I will hand back to Nick again, who is just going to recap on fees, details, and timings for investing in our VCT and EIS portfolios.
Yeah. So the practical details, and these cover both our general tech ventures EIS portfolios as well as the energy transition portfolios. Minimum investment is £10,000. It can be higher, of course. We would invest that typically into at least 10 companies, but I'll talk about diversification in a moment. And each of those companies that we put part of the money into will run on its own timeline towards an exit, which is typically a trade sale. So the company gets sold to a bigger firm. Or potentially it might list on the stock exchange, allowing us to sell the shares. We would expect each of those companies to be in the portfolio for between 4 and 7 years. It has to be more than 3, of course, for EIS reliefs, but we target between 4 and 7 years. Can take longer, of course. We don't quite know when the company will be in a position to achieve its exit. But we would hope across the portfolio that will be a 3 times return. That's not guaranteed, and there will, very likely be some failures within the portfolio. These are high risk investments, but we'd expect those to be balanced out by others that do quite a lot better. And we don't invest in any company with the EIS portfolios unless we think it's capable of, it's got the potential to deliver a 10 times return. But so 3 times is our target across the portfolio. The fees for that, 3% upfront, and then 2% a year, which is capped at 4 years. So we don't charge that management fee after 4 years, which is incentive for us to make sure we don't hold the company longer than we need to before we get the exit. And when it does exit, there is a 20% performance fee, but only on proceeds above 130% of the funds initially invested in that company. So that's the practical details. But I know at this time of year, there's a lot of interest in deploying before the end of the tax year. And for both the ventures EIS and the energy transition EIS, the deadline for getting funds into us is the 24th of March. With the ventures EIS portfolios, we would still target, if possible, 10 companies in the portfolio. Energy transition EIS portfolios, because it's a new product, that would be a smaller number of companies, so there would be reduced diversification in that situation. But you can, there will be a bit of co-investment between them. So if you want a little bit of exposure to the energy transition, you would get that with the ventures EIS portfolios. Or if you want a bit more, of course, no reason you couldn't put an application in on both of those. And then for completeness, we also have the Blackfinch Spring VCT, and any funds and the cleared funds and applications received by 5 p.m. on the 3rd of April will be deployed this year and get a tax relief for this year. So those are our deadlines, EIS and VCT. We have online applications, so please don't leave it to the last minute, but you can do it if your clients are so inclined. Thank you very much.
Fab, thanks, Nick. So we have got 5 minutes left, and we do have just a couple of questions. So Nick, this first one I think is probably for you. How do target exit timescales differ between the Ventures EIS and Energy Transition EIS portfolios?
So the exit timeline, we have very much the same target for both, and that's the 4 to 7 years that I mentioned on the previous slide. As I said, for both products, we are looking for a range of stages at the point where we first invest. We need them to have established what they're doing. We don't go in at the very, very earliest stages. But something like Adia, quite early on, very limited revenues, all the way up to bigger companies which perhaps have a small number of millions of annual revenue. They might be a bit quicker to come through, but really, it's the spread. We target. And we're expecting all of them to be between 4 and 7 years. Of course, there can be different profiles. Some of the energy transition ones might take a bit longer before they get, start sort of really delivering results, but then can take off very quickly when they do. So I don't think it would really, create any difference.
Right, thanks, Nick. We've got time for one more, and the next one that we have here is why aren't there more investment companies providing energy transition funds? So I can take that one. In short, there are others, but they may not be badged as energy transition per se. They may be called a climate tech fund or a climate change fund. We very consciously didn't call ours a climate fund. And that's not because it doesn't tackle climate related challenges. It's because we want our clients to understand it's a diverse and returns focused investment opportunity. So we're not doing it specifically for climate or ESG reasons. We're doing it because we see attractive returns in the space. Where you do find many energy transition funds is in the large scale private equity and institutional investment space. This is an area that Blackfinch has exposure to. We invest in through our next gen listed infrastructure funds. These funds are slightly different in that they're typically focused on large scale infrastructure, whereas we saw far fewer companies looking at the bottom up tech angle. And the opportunities that provides for smaller retail investors. And that was really why we launched the energy transition product, because we see the macro trend, we see all of the momentum in the market, and we identified a niche within that market that Blackfinch really fits very well into with our experience through early stage technology investing, but also our energy experience and property experience as well, all which sits very nicely within that space. We do actually outline a bit more about that within our guide to the energy transition, which we published recently. So if you are interested and would like a copy of that, please just mention it in the feedback at the end of this webinar. On that note, I think we have 1 minute to go, so we will wrap things up. We would greatly appreciate if you do just take 1 minute to complete the feedback form. It's enormously helpful to us to know if the content that we're providing is helpful, or if there are other areas that you'd like to hear from Blackfinch about. Otherwise, many thanks for attending. We'll hope to see you next week for the last of this series, when we'll go into more detail about supercritical, and we'll do another spotlight on another prospective area for future investments. But with that, thank you and goodbye.